Melissa, get out the party hat. Sometime around 3 p.m. this afternoon, the Federal Reserve should announce results of the last purchase of mortgage-backed securities and put an end to the largest quantitative easing program in its and U.S. history. It's the measure of how far the Fed looks to be behind the curve. That the end to QE comes the day after inflation was reported at 7.9%, a 40-year high, and just 6 days before the Fed is set to raise interest rates. That's not to mention a coming inflation surge linked to Russia's invasion of Ukraine. So beginning in March 2020, the Fed cut interest rates to zero, began increasing its balance sheet by $120 billion a month to give more stimulus to the pandemic-plagued economy. Over 24 months, it doubled the size of its balance sheet to $8.8 trillion, may hit $9 trillion before we're all said and done. The $4.8 trillion increase came from buying $3.3 trillion in treasuries and $1.3 trillion in mortgages, and the Fed will actually keep buying assets as paper matures and the Fed tries to maintain the current level of the balance sheet. That is, until it decides to reduce the balance sheet, and that's supposed to happen this summer. And traders are bracing for more volatility in mortgage and treasury markets as a result. QE dampens volatility because the Fed is always in there as a buyer regardless of what the economics are. The volatility, though, could be good for Wall Street firms, boosting trading and other fees. The result, somewhat higher rates to compensate for volatility. So belatedly, markets are going to have to stand on their own in a way they have not, Melissa, in several years.